All right, all right. Welcome, welcome, welcome. 8 o'clock early in the morning, ready to get up and start trading the financial markets. Aren't we crazy people? All right, crazy is as crazy does. Here we go. Let's start talking about what we learned last night in class. As you all know, my name is Lan Turner, and I am the school teacher at Utah Tech University. And we are talking about the dividends that we get from an ETF, exchange traded fund. Very similar to a mutual fund, but not a mutual fund. Again, the differences between a mutual fund and an ETF is that a mutual fund is traded by the professionals, right? We don't go in and manipulate what's inside of a mutual fund. We just buy the mutual fund, give them the money, and they trade it for us. And that's all there is to it. And mutual fund has pretty good expenses, and they're not as liquid. I mean, you can buy them and sell them, but you can only buy them and sell them based on the closing price of the market, and you only get your price once per day. So that's a mutual fund. A little bit more restrictive. And then we come up with ETFs, exchange traded funds, which are basically the same thing. They took these basket of funds, these basket of stocks, all right, and they put them all in one little container. And then they put that out on the stock market just like they would a normal stock. And you can trade those little baskets of stock just like you might trade a single stock. All right. So that's very cool. So if we go through and we look at a couple of single stocks here that we've been talking about in the past, and these single stocks pay dividends. So we got Chevron. All right. So this is Chevron. They gas and oil company, and this is the price of their stock. You can see it's been down here. Let's simplify this just a little bit. Let's go to preferences and we'll lower this down. I got that turned up a little bit too high. Let's just go to 5. That looks good to me. And so we're going to come back over here, and you can see that they were down in here. You can see that they were about $135 a share when they were down here. Now, nobody wanted to buy right here. And remember, the name of the game when we're playing individual stocks is to buy low, sell high, because this is all about growth. Growth. So you want your shares to grow. But nobody likes to buy when it's low. Why? Well, who wants to buy that stock? It just dropped. Like, ooh, I don't want that dumb thing. Man, what a worthless piece of crap. Look, I don't want that thing. But you know what? What do they say? When there's blood in the street, that's when you buy. And so that was a buying opportunity for you for a recovery on Chevron. And of course, it's moved all the way back up over the last 6 months, all the way back up from $135 to $165. So that would have been your profit. Let's say you came in here and you went from here to here. That would have been a 16, 17% move in 6 months. A lot of people will wait. If you're getting 3, 4% from Cash Valley Bank, let's say 4, 8, 12, 16. You'd have waited 4 years to make that same amount of money as what you just made right here on Chevron in 6 months. Okay, so you put your money in there, and let's say we put in 100 shares. That's what this little calculator tells us. $2,283 would have been your profit, or 16, 17% on a 100 share price. Now, what was 100 shares? 100 shares would have been $13,500 because you're buying them at $135 a share, right? And you're buying 100 shares. So 100 shares at 135 would have turned into a profit of $2,283. All right, see how that works? And that's 17%. All you have to do is just draw that little dollar calculator, which is this little tool right up here in Track and Trade. Just grab that little dollar calculator and draw it up there, and it tells you, oh, that would have been with 100 shares, $2,350. Now, of course, you can change it and say, well, I couldn't afford 100 shares, Land. How much would that have been? Okay, well, if you weren't putting in 13,500, you could have put in 10 shares. So if you put in 10 shares, that's 1,350, right? So we get rid of that 10, and that'd have been $235. All just a bunch of zeros at the end. Okay, so that's how that dollar little thing works, and you can tell what your profits and losses would have been based on the movement of the market and just drawing that little line on the tool. That's why it's nice to have a professional trading platform rather than just a chart that sits on just one of the advantages of a more professional, but it's a little bit more expensive too, but you pay what you get for. All right. So here we go. So that's a dividend stock. So you come over here to Johnson & Johnson, and there again, the name of the game is to buy low and to sell high. All right. Now, the problem is with trading is that nobody wants to buy low. They didn't want to buy down here. Why? Because it's low. It's a rotten stock. It's a low price, been coming down, down, down. Who wants to buy stocks going down, 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 right? Now, we teach a class, or I teach a class, me and the university, we teach a class called day trading. It's called a day trading class, but really what it is, it's a technical analysis class. And technical analysis is how you read all these indicators. So indicators are the magic, way that mathematics reads the market. So we have lots of different tools that we can use to help us identify when it's time to buy and sell on different markets. And so we use these tools to help us make our trading decisions. And that class is coming up in a couple of weeks. It's called the day trading class, but it's really all about technical analysis. And then we do technical analysis, we learn that, and then we apply it to day trading. So you can take that class so you can learn all about how these indicators work. And I would recommend you do that, because especially if you're in the class doing the dividends, we're going to start doing longer term position trading, right, to collect those dividends. We're going to do what we call yield first trading, because right now this is growth first. So remember, we have two ways of making money in the stock market. You have growth and you have yield. And so when we do individual stocks, we talk about the growth. How much money did that grow over a period of time? And that would have been your profit between here and here. Let's do our little dollar calculator here on Johnson & Johnson. And from there to there, that would have been 100 shares, which would have been $15,000 roughly. $15,000 over a 6-month period. 1, 2, 3, 4, not even full 6 months, just 4 months. You'd have made 23%. So that's $3,576 in that 23% return. Now, granted, it's very true the market's been on fire the last 4, 5, 6 months. Okay, it's just lit like dynamite. So past performance is not necessarily indicative of future results. So we have to take that into consideration. But nonetheless, that's how that works. You get 23% in 4 months, and that's unreal money, right? That's really, really super good on Johnson & Johnson growing that much in 4 months. Is it going to maintain that? Well, we don't know. We can make our projections and our guesses and our mathematical models, and we can say, well, we're probably going to see it come back down a little bit before it goes back up, right? So it'll give us what we call a dip in the market, and we would like to see this come down to our mathematical modeling of around this little circle right down in here somewhere, so that we could buy it back down where it was down in this region. If it would come down in there, we'd be happy and we'd pick some up, we'd buy some. But Lan, what if it turns and comes back down here even farther? Well, okay, don't buy everything you got, because you might want to put some in if it comes down here. Lan, I don't want to buy a market going down. Exactly. Buy low, sell high. All right. So you got to buy low, sell high. And that's the whole name of the game. And that's why it's hard. That's why it's hard. It's hard to want to buy a stock that's doing poorly, but that's what you need to do. And then the stock needs to do well after you buy it low. And that's hard too, because maybe it won't go back up. Maybe it'll just stay down there and you don't make your money. But Lan, I got a car payment. Exactly. That's why we start leaning towards yield. All right. Remember, there's two different ways to make money in these markets. One is with the growth, and one is with yield. And so now, if your growth isn't doing so well, you're going to have to lean on your yield. And so that's where we come over to this little tool here, which is a little internet tool that tells us what the yield is. Okay. Track and trade is more of a growth tool. This is all based around growth, how to grow your portfolio. And growth is important even when you're doing yield, because you don't want to buy a poor stock just because it's got a high yield. You want to, take into consideration both growth and yield. Growth and yield are both important. So even when we get into this world where we're going to switch the playing field, all right, we're going to go from a growth first to a yield first. All right. So we're going to go from growth first to yield first. The whole world has always been concentrated on growth first. And that's what everybody's been taught their whole life since they were in kindergarten. You got to buy low, sell high. And that's how you make money. Or you go work for somebody, whichever comes first. All right. So you go work for somebody and you trade your time for money. And that's okay too. Nothing wrong with that. But that's not how the rich get rich. And that's not how the wealthy get wealthy. So if you want to be wealthy, we got to do something different. Can't always be trading our time for money, because we don't have enough time to trade for as much money as we want. Right. So that's where you have to get a raise, and you have to get more money for the same amount of time. Well, it'd be easier if we could just get more money and not have to work for it and trade time for it at all. So that's what we're going to do here, is we're going to take our growth first and trade it with yield, but our yield has to be higher. So it's like getting a raise. All right. Right now, if we come and look at Johnson & Johnson, we pull up this, let's see, this little tool right here. And we go into Johnson & Johnson, J&J, which is the ticker symbol. Hold on a second. I'm got to take a drink of water. All right. So if we come in here and look at Johnson & Johnson, we got to go to, let's see, our little charts here. No, not that one. That's, I hate those. Let's go back over to, how do we get out of here? Home. There we go. Now we go J&J. All right, there we go. So Johnson & Johnson pays out its dividends quarterly. So if you come in here and you can look, Johnson & Johnson gives you $1.30 per share. And let's say, pretend like we bought them back here at 150, right? We've done this math. We did it in our last class, but we're going to take the number of shares divided into the amount of money that we invested. Let's say $10,000. That gives us the number of shares that we'd have. And then we multiply the number of shares by the dividend, and that would have been our dividend. But we had good growth on Johnson & Johnson between now and then. So we had growth that went up in there. Plus we got the dividend. So you get the dividend and the growth. So that's the two ways that you can make money. Now, the dividend on Johnson & Johnson, it's so tiny. It's if Johnson & Johnson doesn't go up in price and you can't get some growth out of it, you're probably certainly not going to be living off of your Johnson & Johnson dividends, because they're tiny, unless you have tens of thousands or hundreds of thousands of dollars in Johnson & Johnson. If you do, then your dividend will be big enough that you could probably live off of it. All right, but that's a problem. Their dividends are so tiny that you probably can't live off of them unless you have hundreds of thousands of dollars in the Johnson & Johnson. So what we're going to do is we're going to go look at something else. We're going to go look at a basket of stocks that have dividends, so that you can buy into that one basket of stocks, or that ETF, exchange traded fund. And that exchange traded fund has a basket of stocks with a whole bunch of stocks in it that have dividends. And then the dividends are going to be more because you got more participation in the dividend. All right. So let's go do that. And that's what we did yesterday in class. Last night in class, we talked about what are dividends, or what are ETFs, exchange traded funds, and what are some dividends. And this was our list. So this was the list we had last night in class. So for those of you who were not in class last night and joining us today, take out your little cell phone, get the little camera on there, and snap a picture of that, because this is one of a list of some of the very top, most popular, common ETFs that the world trades to get both growth and dividend. All right. So growth and dividend. So go ahead and snap a picture of that, and we're going to go talk about some of these. You got snapped your picture? All right. So now let's go back over, and we're going to pull some of these up, and we're going to look at them, and we're going to see. Now look, now notice that this is $1.30 per share, but the share price to buy it was $150. If you want to buy into it right now, it's $187. So let's just do the math on this one Johnson & Johnson real fast to find out what that is. And I'm finding, we're going to go do our little calculator. Okay, here's our little calculator. And we're going to come in here and we're going to go 100. We're going to do $10,000, because that's how much we're going to invest, right? $10,000. And then it's $187 a share. So we're going to divide it by 187, because that's how much we can buy right now. So that gives us 53 shares. So 53 shares, and then we get $1.30 for every share we have. So we're going to go times 1.30. So it gives us $69. And they're going to give us, with our $10,000 investment into Johnson & Johnson, they're going to share their wealth with us every quarter, every 3 months. Every 3 months, they're going to give us $69. Aren't they kind? All right. So that is your dividend paying stock. So what we want to do is we want to get more than that. It's not enough, right? We always want more. We want more. So we're going to come in here and we're going to go to an exchange, or an ETF, an exchange traded fund, that's going to give us possibly a little bit more than that. So let's come in here. And last night we looked at SCHD and SCHG. SCHD. All right. And there's SCHD. Now, remember, we're going to start trading a pair. We're going to trade these in pairs. So you got to start thinking about when you're doing yield pairs, because when we get into the high yield stuff that we're going to start talking about on Monday, we're going to do pairs. And it's really important to think of pairs trading. Okay. So we're going to come in here and we're going to say SCHD. Now, SCHD, again, pays out quarterly, but it pays 26 cents per share. And you're like, what? That's a lot less than Johnson & Johnson. Yes, but the share price is only $26 a share. It's not 200 and something, right? So we're going to come in here and we're going to do the same little math program. We're going to come in and we're going to say $10,000 and we're going to divide it by the dollar amount, $26. And that gives us 384 shares at 0.26. 26 cents. Oh, 384 divided by 0.26. Oh, no, not divided. Sorry. 384 times 0.26. 0.26. Okay, that gives you, going to give you 384 times, not, it's got to, I'm doing this wrong. 384 times 0.26. Okay, that's going to give you $99 per share. All right. That's more than Johnson & Johnson. So there you go. This has SCHD has a higher dividend than Johnson & Johnson. So now you can come in here and you can put your money in here and you're going to get more dividends on a quarterly basis than Johnson & Johnson. Now you can come down through here and it's going to point out and it's going to tell you what this thing is invested in. Okay, so it's invested in all these funds. These are the different stocks that are in SCHD. In fact, we can say open show all. Okay, so this is the basket of stocks that SCHD would, if you buy just that one share, right? If you go in and you buy, let's say you've got let's say you got $30 and you want to invest it. Well, you could buy one share of SCHD, and that's all you'd have to do. You go into your brokerage account, whether it's your little phone or whether you do it through Track and Trade, and you place an order and you say, okay, I want to buy one share of SCHD. Well, that would cost you $26.61. That's it, $26. But remember, when we looked at Johnson & Johnson, Johnson & Johnson over here is trading at $188. So you'd have to have $188 to get one share of Johnson & Johnson. And that's it, just Johnson & Johnson. That's all you'd have. You'd have one share of Johnson & Johnson. But if you come over here and we do this one, we get one share for $30 of SCHD. Now, if we do that, SCHD is going to give us a piece of all these stocks. ABBVE, Cisco, Merck, Amgen, Lockheed Martin, Coca-Cola, Pepsi, Chevron, Conoco, Altera, Home Depot, Verizon, Bristol Myers, Texas Instruments, United Parcel Services, EOG, SLB, Valera Energy, Ford Motor Company, Fastco, Target, ONET, Kimberly-Clark, Paycheck Inc., Archer, Fifth Third, Hershey Company, General Mills, and Cincinnati Financial. So if you bought one share of SCHD with $30, you would own part of all those companies. Now that's pretty cool. That's called diversification. All right. You're not putting all your eggs in one basket. You're not putting all your money in Johnson & Johnson. You're spreading it out across all these different companies. And all you had to do is buy one share of SCHD to get a piece of all those companies. You don't have to go out and buy them all individually, because even just to get Johnson & Johnson, you'd had to pay $200 to get just one piece. And that's the minimum you can buy, right? One piece of Johnson & Johnson. Now, there are some brokerage firms that let you do fractional shares. And fractional shares mean that you have the share price, right? And the reason they call it the share price is because that's how much it costs to buy one share. So that's the minimum amount you can buy. But there's kind of a new thing, and a lot of firms let you do it. Well, I can take that back. Not a lot of firms. There are a few firms, a couple of firms. In fact, there's not very many. I take that back to the point that there's only like one or two that let you do what they call fractional shares. So you just go in and say, well, I only have $10. Can I buy $10 of Johnson & Johnson? I can't afford one share of Johnson & Johnson at $188 a share. I only want $10 worth of Johnson & Johnson. And there's a couple of firms that will let you do that. All right. And that little Robinhood calculator thing, little Robinhood firm that we talked about, that's one of them. They'll let you do it just by the dollar amount. Okay. So that is how you buy this. So you could actually go buy and take your $30. And if you wanted to, go buy just a little bit of piece of each one of these. But oh my goodness, I'm losing my voice. Give me one more second. All right, I just got cold water this morning, not some hot tea. So I'm working on cold water. All right. So that's the name of the game. All right, there we go. So let's come back over. And what else can we look at with SCHD? SCHD, we're going to do our math on this thing, and we're getting 26 cents. So we saw that we got $99 every quarter, every 3 months on our $10,000. Okay, so that's better. So now remember, SCHD is the D stands for dividends. So this is the dividend version. Now, if we come over and we look at the SCHG, SCHG is growth. We're going to say show all. And now G stands for growth. Uh-oh. What did I do wrong? Come on. All right, so this is SCHG. So SCHG, again, remember they're pairs. They're both from the same company, Schwab. Schwab is the one who's taking care of this. That's why it's SCH, because it stands for Schwab. And then the D stands for dividend, and the G stands for growth. So we're going to come in here now. This is SCHG. Now, SCHG still gives a dividend, but it's tiny in comparison, right? So this is a $33 stock, and it's giving a 3-cent dividend per share. So I'm not going to do the math in the interest of time because we've got other things we want to look at. But that's telling you that right now, this is not a dividend paying stock. It's a growth stock. So the whole theory of this is that depending on your age, all right, and generally we like to think of your age. So whatever your age is how much you should have in SCHD for dividends versus G for growth. So if you're 25 years old, you should have 25% of your money in SCHD for dividends and 75% in growth. And then as you get older, you start investing based on your age. So once you get up to 50 years old, you're going to be putting 50% in growth, 50% in dividends. Once you get up to 60, 70 years old, you're going to be having 70% in dividends and 30% in growth. Okay, so it's going to be a smooth and natural transition, and you can just basically do it on your age. However old you are is how much you're going to be putting in each one. Okay. If you're younger, you're going to be putting it in growth. If you're older, you're going to be putting it in dividends so that you can take out the dividends and get paid that check. Okay. So as you grow, and that's the whole concept of this SCHG and SCHD. And SCHG, we're going to come in. I'm going to show you how to do the comparison. Now we're going to use this little FinBiz program. You come in here, see this little compare right here, right up here on the menu. So we're going to hit compare. And that brings you into another window right here. And I just put them in there, SCHG, SCHG, and SCHD. So you're going to see one is growth and one is dividends. So this one here is growth. Look at it grow. Woo! Nice growth. Okay. This is dividends. It's not growing. Why is it not growing? It's invested in basically the same thing. There's a little bit of difference, but for the most part, there's a lot of overlap in there. But nonetheless, this is more dividend stocks. These are more growth stocks. And so the dividend stocks, the reason they don't grow is because they actually are growing, probably close to the same rate as the SCHG, but along the way, they take the dividends and they give them to you. So whenever they take the dividends out, the stock goes down. So you have two baskets. All right. Think of that as two baskets. What happens, you have a basket that's got all of your money in there that you put in. And then every time it makes money, rather than putting it back into the same basket, it gives it to you as a dividend. And so that means it's not going to go up. The value of that basket isn't going to increase because they keep taking money out of it and giving it to you to go buy your groceries with. All right, so that's how that works. That's why this one doesn't go up in value. It's not that it's not going up, certainly is, but it's the value of the basket of funds, of how much money you've got in the basket of funds. So the basket of funds doesn't go up because they keep taking the money out and giving it to you. So the basket of funds can't go up because you keep taking it out. If you don't take it out, as in this case, which doesn't take it out, right? Very almost no dividends at all. Well, the basket grows. And so if the basket grows, well, in the future, sometime you're going to have a bigger basket. You can start taking it out of that fund. So two different methods, two different concepts. One is that you have to, delay your gratification is on this one here. This one here gets immediate gratification. So it's going to start giving you money every quarter, every 3 months. They're going to send you a little check and you got to go spend it. So that's why the fund doesn't go up, because they're sending the check to you. This one, they're not going to send you any check. You get no check. Sorry, no check. But that means that your fund goes up. So if you like to watch your little money thing go up, oh, yeah, it's going up. Oh, I'm so happy. Woo, look at it go up. You want growth. If you like to get money coming to you, oh, look at the money they're sending me. Oh, I love money. Oh, it's coming to me. I get to spend it. That's yield. The orange line is yield. The blue line is growth. Okay. So that's the difference between SCHG and SCHD. Now let's compare those to the S&P 500. The S&P 500, if we come back over here to our home screen and we go to our stock symbol and we go in SPY, now this is the S&P 500, and remember, this is the gold standard. This is what everything else is benchmarked against. Benchmark meanings that we always compare it against this one. All right, so this is the gold standard of the industry, and so everything is benchmarked against the S&P 500. So that's the SPY, and you can see it's just been going straight up since back in April. It just went. This is unreal. This is like, we've only seen this one other time, and it was like what 8 years ago. So markets just don't do this. This is craziness. Okay. So usually we get a little bit of a dip in here, a little bit better dips. Buy the dips. And these dips have been so tiny, we just keep, when's it going to dip? When's it going to dip? It just never does. This is a nice dip. This was a big dip. In fact, that was a little bit too big, but it was a scare dip. Okay. So we got scared, but then the recovery was like unbelievable. So let's come back over and go back over to our compare. And we got SCHG and SCHD in here. Oh, it's got SPY. So that's SPY. That's the S&P. So we're going to add in here. We do comma separated, and we're going to go SCHG, and we go SCHD. All right. So SPY is the blue one, and that's the growth, right? S&P is growth. And then you got SCHG, which is growing a little bit better. It's growing better than the S&P 500. So it's benchmarked against the S&P, and you can see that SCHG did 29%, whereas the S&P did 20%. And remember, I told you S&P is like, oh my gosh, we've never seen this before. It just doesn't do this. It doesn't have this good of years. And so having the S&P making 20% when it generally makes 10% is doing double of what it normally does. Well, SCHG is doing double of what it normally does. Okay, SCHG is up there almost 30%. 9%, almost 10% higher than the S&P 500. That's huge. I mean, the S&P usually only does 10%. SCHG is 10% bigger than the big S&P. So that's pretty good. All right, making 30% this year. That's a lot of money. Okay, now SCHD, look, SCHD is down 5%. You're like, well, if I had my money in SCHD, I'd be doing really badly. I'm losing 5%. No, you're not. Okay, you put your money in there, and yes, it might have gone down 5%, but the yield on it is high enough that would have been paying you a dividend. You've been taking your money out. So the difference between the growth, maybe somewhere between what it's doing stock-wise, the S&P 500, and where it's been taking the dividends out, that's the money that they've been giving you. So that money in between those two numbers, that's all been coming and going into your pocket. And that's how much you've been putting in your pocket as a dividend and making money and living off of. Okay, so whenever you take money out, it can't go up. That's the whole game, right? Can't go. You're not saving, big and a big snowball. You're just keeping the little snowball small because you keep taking all the other snow and putting it in your pocket and go spend it at a grocery store. All right, so that's that one. Now let's go over and look at a different one. Okay, so that's SCHG, SCHD. And now you're going to want to do a little bit of math, do a little bit of checking out. That's why we give you these symbols, and you can come in and decide which one you want to put your money in. But Lan, I don't want to decide. I just want you to tell me. Okay, well, I'll give you some trade recommendations, but I can't tell you what to do. I can just tell you what I'm doing, and then you can decide what you want to do. So what I'm doing is I like to look at what's best, what Grok says is good, right? We can use Grok and say, tell me the very biggest, best, most popular ones that everybody else uses. Those are probably the ones that we want to be looking at. Now, not always do we want to be a member of the crowd. Sometimes we want to be a contrarian, but for the most part, the stock market is a Me Too industry. It's like, if that's what everybody else is doing, that's probably what I want to be doing too, because those are going to be where the big growth funds are. All right. So it's a Me Too market. And so volume and participation is what makes markets go up. And you're like, well, I want to do something different than everyone else. Okay, that's called a contrarian. And there is a place for that. And you can do that type of trading to try and be first or but usually for growth, for long periods of growth, you want to be where the crowd is, because they're the ones putting all the money in. That's where all the money's going into. And so those are the ones that are growing. And that's what this list is here. This is the big boys. All right. These are the ones. And you can see the size of the fund. That SCHD has $72 billion in it. That's a lot of money. 72 billion. SCHD has 51 billion. Okay. So a lot of people like those dividends that are coming out of SCHD. An SCHG at 51 billion is a lot of money. All right. And it's doing better than the S&P 500. So that's pretty good. So the next one, let's look at the next one. The next one I want to look at is JEPI and JEPQ. Again, it's going to be a pair. Let's before we go look at JEPI and JEPQ, just for fun, let's look at VIG. VIG is the Vanguard Dividend ETF. 115 billion is the biggest one in the whole world. The dividends on it are about 1.64, not nearly as good as SCHD at 3.79, but 1.64. And so we're going to go look at the VIG. Lots and 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 lots of people have the VIG. All right, so let's go take a look at it. Actually, let's go look at it in the charts first. VIG. This is what VIG looks like. So it's got some growth. Looks just like the S&P, doesn't it? And what's the dividends on it? Dividends are 86 cents a share. Let's go do some math. Let's see how our little $10,000 is doing. So we're going to take our little calculator, and again, we're going to do $10,000. So do your $10,000 on your calculator. Come on, Lan, push the right buttons. So $10,000, right? Show it to the camera. 10,000, and then we're going to divide that by 217. Divide by 217 equals, that's $217 per share. That means they'd give us 46 shares on the VIG. And then they're going to give us 86 cents in so that's the growth. All right. And now we're going to look at the yield we're going to times that 0.86, because they're going to give us 86 cents for every share we own. So they're going to give us every quarter on the VIG, they're going to give you $39 on your $10,000 investment. Okay, $10,000, they're going to give you $39. So it's not really focused as much around the yield. Growth plus yield is your total profit. So your yield is very small, 86 cents per share, which is much more than others, right? But the share price is $200. And as that share price goes up, it costs more and more money to get your 86 cents. So let's go see, that's 86 cents in October. What did they pay in July? 87 cents. So it was 1 penny more when the shares were 200 instead of 217. What about back here? It was 93 cents. So they paid 93 cents back here when the shares were trading at roughly $194. So you can see they change a couple of pennies along the way. And as the stock goes up, remember the share price is going to go down, because the share price is mathematically calculated into how they come up with the dividend payout, because they're paying a dividend, which is a performance of the stock or the performance of the company and how much money they're making. All right, selling their widgets, whatever it is. Now, VIG is an ETF. See, it's an ETF, exchange traded fund. It's actually an FTF, but to just think of it as the same thing. It's a basket of stocks. Okay, so we're going to come in here and we're going to go open this, show all. We're going to show these are all the ones that if you put your money in VIG, this is what VIG is invested in. Broadcom, Microsoft, JP Morgan, Apple, Eli Lilly, Walmart, Bank of America, Cisco, Goldman Sachs, McDonald's, Pepsi, Intuit. Okay, so they've gone through, and you can see that it's weighted. You'll notice that down here, the ones that are at the bottom of the list have a much smaller weighting. They're not equal weights. They don't put the exact same amount into it that they do in Broadcom. Broadcom is 6% of this VIG's holdings. They really like Broadcom, so they put a lot more money into Broadcom. They like Intuit, but not enough to put very much money into it, only 0.89. Not even 1% of your investment is into it. All right. So that's how that one works. So that's the VIG. And there's no pair to the VIG. So you'd have to find another pair to pair it with if you wanted to do dividends and growth. But this one is supposed to be giving you both the dividends and the growth under one window. Okay. All right, let's go back and look at this one here. I want to do JEPI and JEPQ because it's another pair. You can look at some of these others. This is VYM. You can go look at that one. It's going to be a single. There's not a pair for it. So it's going to be trying to give you growth. It's going to try to be matching growth with dividends. Okay. But JEPI and JEPQ, they do something different. All right. So we're going to go look at JEPI and JEPQ. And this is going to start giving you a little bit of a window into what we're going to be doing next week with the high yield stuff. All right. Because this is where the idea came from. So we're going to pull up JEPI, JEPI. Now, JEPI is by JP Morgan Chase. And JP Morgan Chase, just a big bank, right? And they manage this fund. Now, notice that they give you your dividends every month. And again, I was asked the question in class, why? What's the difference between quarterly and monthly? Well, the longer they can hang on to your money, the more money they get to make or the more money they can grow the fund. So they don't want to pay out their fund as often, very often. But when other companies start paying out their funds more often, then they're in competition. They want to keep people coming to their fund, right? So they have to go down and start doing monthly. So if somebody starts doing weekly, well, they have to start doing weekly. They have to keep up with the Joneses, right? They want to, it's the Pavlovian dog process. You ring the bell, and then all the dogs come running. And so they're hungry. They start salivating before they ever get the food because you're ringing the bell, just because you rang the bell. Well, if you ring the bell every quarter, everybody's going to start salivating for their dividends every quarter. But, oh, that guy over there, he pays it every month. He rings his bell every month. I get fed every month. So the whole crowd, the throng, the mob, right, runs over there, and they want to be in the market that pays them every month because they could ring the bell every month. They get their paycheck every month. Well, now somebody's starting to do it every week. Oh, everybody floods over to the guy that's doing it every week because he's ringing the bell, and the Pavlovian dogs are all running to where they can get their money, get their food every week. So that's the name of the game. You got the managers who feed the dogs, and then you got the dogs. Guess what we are? We're the dogs. All right. And that's okay with me. I don't mind being a dog. But you can be the master if you want to. You can trade these funds if you want to on your own and then share the money with anybody you want or keep all the money yourself. That would just be self-directed trading, right? Self-directed trading, you're the master. You're the master of your own world. You're not expecting somebody else to make the decisions for you. In this case, you're going to come to JEPI and you're going to say, hey, JP Morgan Chase probably knows more about trading than I do. Therefore, I'm just going to give my money to JP Morgan Chase. And then they're going to invest my money for me on my behalf. And they're going to put all my money into these stocks right here. NVIDIA, Alphabet, Microsoft, AbbVie, Home, South, 3M, Lowe's, PepsiCo, Intuit, McDonald's, Mediterranean, or whatever. And they're going to, look, they like 187% in NVIDIA and 1.27% in Medtronics. So they're spreading it out at a different rate too. They're not putting it all equal amounts of money. So they kind of pick and choose for you, and they decide what they want to put their money into, and then they'll take some out and put some new ones in, and they'll modify and change up this basket of funds. All you have to do is just give JP Morgan your Chase your money, and they will trade it for you on your behalf and pick the stocks for you. And that's the name of the game. And so they want to try and pick stocks better than the next guy, the other companies, the other big banks, so that because this is how they get paid, right? By trading and putting their money in these things, and then they take the fee. And so they want you to come and put your money with them so that they get the fee for trading your money in the stock market. Now, the stock market's got 3-4, New York Stock Exchange, the There's about 15,000 stocks out there that you can pick from. All right. And what you find is that as you get, up to the top, the cream of the crop of the 15,000, the little bottom, most of the bottom ones are just little dinky companies that most people don't trade or pay much attention to. Now, some people will, because, those are the ones that can take off and be the big winners if you want to watch what we call penny stocks or tiny stocks, right? But for the most part, the cream of the crop are the big companies, the big firms that you're very familiar with. When you read down through the list, you know who they are. Those are the ones that end up in these big funds. And so they're trying to pick just the best cream of the crop and what percentage is and there's just kind of a small differences between each one that decide what the managers want to do, excuse me. And so then this is the dividends that these different companies are kicking out. So if they want higher dividends, they're going to pick stocks that have bigger dividends. If they want more growth, they're going to pick stocks that have more growth. And if they want a combination of those, they'll kind of try to do what VIG did, right, which is try to put both in there to try and give you a little bit of both in the same fund. But JP Morgan, they say, no, we're going to kind of do something different. We're going to come in, we're going to do the pairs trading, just like SHG, SHD, and we're going to pairs trade those. And so those are going to be, we're going to put money in one for growth. We're going to put money in the other one for dividends. But they're going to trade them on different markets. They're going to trade against, JEPI trades against the S&P 500 and for dividends. And then JEPQ trades against the NASDAQ for dividends. All right. Now, what they do is they do something different. They trade options on the S&P 500, and they trade options on the QQQ or the NASDAQ. And they do what we call a covered call strategy. So they take that covered call strategy. This is what JP Morgan Chase does on JEPI and JEPQ. And they trade options with a covered call, and they take the premium. Now, if you don't know what an option is, you can buy an option and you can sell an option. All right. We're going to learn more about this next week, but you take the premium when you sell the option, somebody has to pay you for it. And that premium is what it's called. You get the premium, and then that premium becomes income to you. All right. To the person who sold it. So JP Morgan Chase is selling options, taking the premium. And so that becomes their dividends. So they have dividends that come from the shares that they have in the company, just like the normal dividends, the profit shares, but they also trade options on them. And because they're trading options, they get that premium coming in as a dividend. That makes their dividends higher. Okay, so here we are going to look at JPI, because not only are they getting the dividends, which, as we know, most of them are why bother, they're tiny, but they're getting premium from options too. So they got growth and options premium combined. Okay, so let's come in and we're going to do our little calculator once again. We're going to take our little calculator and we're going to put $10,000 in here, $10,000, and we can buy, how many shares can we buy with 50? They're $56 a share. So we're going to divide 10,000 by $56, and that gives us 178 shares. Now remember, dividends are always paid on the number of shares you have, not what you paid for them, not how much money you paid for them, but just how many you have. So once you buy them, you always want to buy your shares at the lowest price you can possibly get them, because that's going to give you a bigger return percentage-wise on your dividends, right? So that's why we'll dollar cost average. We want to buy low. As these markets dip, we want to buy them so we can get those dividends. Of course, remember, dividends sometimes go down even when markets go down. Or they go up when the markets go down. They go down when the markets go up. So when they go down, you're going to get a little bit lower dividend. But when the market turns around and goes back up, you're going to get the growth, plus you're going to get a bigger dividend. So here we go. Dividends are at 48 cents per share. We're going to go times 0.48. So you're going to get $85 per dividend, not quarterly, monthly. Okay. And you're going to get 4 of those in a month. So now we're going to go times, or 4 of those in a quarter. 4 equals $347 or $342 on your $10,000 investments in JEPI. Mic drop. All right. What were we getting on SHD and SHG and on all those? Oh, we're getting like $20 a quarter. Right. And then we were saying, oh, let's get this one over here. It's really good at $80 a quarter. Now with JEPI, because not only are they doing dividends, But because they do that little special thing where they sell some options premium and collect a covered call, now you're getting $342 per month. No, $342 was what, because I multiplied it by 4. $85 per month. So what these other companies are giving you, the best of the other ones are giving you per quarter, JEPI's giving you per month. So almost 4 times the money. $342 on your $10,000 in JEPI. That rocks. Okay. So now let's go over and we're going to go look at JEPQ, JEPQ. So write that down. Let's take a little piece of paper and we're going to write it down. We're making $342 per quarter on JEPI. And then that was $85 per month. All right, so we're going to write that down, and that's on JEPI. So I got my notes. So that's what we're making on JEPI. Now we're going to go look at JEPQ. So show all results. So JEPQ. Now we're going to do the same thing with JEPQ. We're going to come in here, and we're going to come in. We're going to say, okay, I got $10,000, and I'm going to divide it by the number of shares. I can have 59. Divided by 59.21 equals 168 shares again. And what's it paying out? This last time it paid out 44 cents. So we're going to multiply that 168 shares times 0.44. So it's paying you $74 a month. That's on the QQQs. So they're trading options on the QQQ, and so they're getting $74 a month. So if we do times 4 for a quarter, it's $297 per quarter. So JEPI was $342 per quarter, and JEPQ was $297 per quarter. And remember that we were looking at SCHD, and it was like $90 a quarter. So this is almost 3 times as much as you were getting in SCHD and SCHG. Now, and you're also getting some growth. The SCHG grew much more than JEPQ. So you have to kind of apples to apples and oranges to oranges, right? So it's still a little bit hard to do the math and see which one is exactly the best, but you're kind of getting the idea that these guys that trade options are going to make a little bit more money. Plus they're still having a little bit of growth in there. And so that's good. Now we're going to go over to a calculator in what we call the portfolio matrix. And we're going to pull some of these up. I'm going to pull up this little calculator. And this is the neatest thing that you're ever going to, I'm going to say, neatest thing since sliced bread. But I promised everybody I was going to stop saying that because nicely done, Jay. Feed me, Seymour. All right. So we're going to come in here and we're going to put in JEPI. All right. So this is JEPI. And this is from Portfolio Matrix. And Portfolio Matrix is one of the only places I even know of that has this calculator. And what it does is it calculates both the gain and the yield. The gain and the yield in one place. So you can see the difference. So the gain on JEPI was a negative 2.67. Okay. But the yield, and this is over the last year, and again, remember, we had this bad start, and then we dropped down here, and then we come back and had to recover. So on the recovery of JEPI, you had 267. You just do the last 6 months, knock off that big bad. It's about the same, isn't it? So the gain is 2.34. So we have at least a positive gain in the last 6 months. So after that big drop, before that big drop. So we got a gain of 2.34 on JEPI. And the yield is 3.61. So we're getting a yield, right, which is your interest rate on the money, 3.61, plus you're getting a little bit of growth, 2.31. So we're getting gain plus yield is 5.95%. That's JEPI, all right? And they're making that money using options trading. So now let's come in and let's look at JEPQ, JEPQ. So now we're going to be able to compare apples to apples. So now we can come in and JEPQ. Look at JEPQ. Holy cow. Oh my gosh. The gain on JEPQ over the last year, this is the year, was 8.30. So it gained some. That's nice. Hey, it wasn't as good as as SCHG. SCHG was like really big gain, right? But SHG didn't give us, well, we're going to go look. The yield was low on SHG. But this gives us a yield of 11%. If you add the gain plus the yield, you're going to get a 19% return on JEPQ. That's pretty good. Let's write that down. So JEPQ is going to give us a 19.32% annualized return. Now, let's go look at it on a 6-month return. So we see it's not going to take this big thing into, it's not going to be much different, I think. Yeah, it's not much difference. 19.06, 19.06, because that recovery, it started, it went down, recovered, and then it went up. So 19.06, that's pretty good. JEPQ. Now what? Let's do JEPI again. I forgot what it was. JEPI. Okay. 5.67. Well, JEPQ blows it out of the water, right? So JEPI was only 5.67%. That's still better than you can get at Cash Valley Bank. Okay. So now we're going to come in. Let's go in and look at SCHD. SCHD. So this is SHD. This is the dividend version. And they, admittedly so, have been having a little bit of a struggle this year. Oh, that's still SCHD. SCHD. No, let's SCHD. Come on, Lan. SCHD. You can spell with your fingers. There we go. All right. They're down 1.28. So their gain was a -5. So SCHD hasn't done well this year. They've struggled. Okay, down 5%. And then their yield is 3.7%. So their yield tried to help out. All right. They got good yield, almost 4% yield. But they've been down. So you'd have lost 1.28%. So let's write that down. We're going to say SCHD has lost 1.28% this year. Negative. Okay. So good thing we didn't have any money in that one. Okay. So now we're going to come in here. SCHG is the growth. And that one had gain of 26%. That was our big growth. Very happy. Now their yield, again, their yield was tiny because they have all the growth. So they didn't pay it out, 0.42. But that gave you 27%. So SCHG with growth and yield, which is yield was almost why bother, was 27.30%. That's just crazy money. 27% return. Now remember, we always generally use the S&P as our benchmark at 10%. And we say if we can get 10%, we're usually pretty darn happy. We're just like jumping up and down. Oh gosh, I got 10%. Okay. Well, SCHG last year, because it was all about growth, not so much about yield, was 27%. But that means you would have to sell your shares to take the profits. And what happens if you sell the shares? Well, then you have less profits next time. And then you sell some more shares. Then you have less profits next time. So then you sell some more shares. Then you have less and less and less. And eventually what happens? You run out of shares to sell. And now you don't have any money coming in and you're still alive. So you need to die before your money runs out. That's the whole stress of the stock market of, you know, you're going to run out of money before I die. I can spend all. So then what happens? Nobody spends their money, because they're afraid to do anything. So then they won't go on vacations. They retire. They won't go anywhere. They barely buy they're penny pinching all their groceries, and they don't want to go out to restaurants and get breakfast because they're like, what if I have to sell some more shares and run out of money? And it's very stressful on people, right? So it's better to have, when you're in retirement, to have a yield first strategy where you don't have to sell your shares. And remember, they pay you the yield. They pay you the yield without selling shares. And in SCH or JEPI and JEPQ, they give you the yield, they give you the dividends, but you don't have to sell your shares. So if you can get those dividends up high enough where the dividends coming in are a big enough amount of money that you can live off of them without having to sell your shares, you don't have the stress of having to worry about, oh no, I'm going to run out of money. You can live to be 150 years old and you're still going to have enough money because it's just going to keep, as long as the market keeps functioning properly, right? And if the market doesn't function properly, we're going to have bigger problems than worrying about our dividend shares. All right. So, but the market's been functioning properly for hundreds of years. We're going to just consider and assume that it's going to continue to function properly into the future. All right. I know there's always some question about what's going to happen in the future, but there's been that same question ever since I was, a little tiny boy. And ever since I've been in the industry, 40 years, everybody's been saying the market's going to crash and die and never come back tomorrow. And if I had a nickel for every time I heard somebody be a pessimist and say that the U.S. stock market is never, the U.S. market is going to decline to the point where you're never going to be able to survive off of stock trading, then you know what? If that happens, your houses aren't going to be worth anything either. So it's like, oh, you should be in real estate. Well, if the stock market goes to zero, what do you think your house is going to do? You think it's going to maintain value? Well, maybe a little bit because you can live in it, right? But as an investment, it's probably not going to be a whole lot. I don't know. It's going to be a crazy world. That's why I think everything's going to be fine. I'm a things are going to be fine guy. They've been fine for me for 40 years. Just markets are going to be fine. All right. Don't worry about it. Don't sit there and say we're going to crash, burn, and die. Because if it does, then you know what? It's not going to matter anyway. That market goes to zero. It ain't going to matter anyway. All right. There's going to have to be some sort of a massive catastrophe to make that happen. So let's just not hope for that. Let's not plan for that. Plan for the best. Right. Plan for the best. Plan for the best. Hope for the best. Plan for the worst. No, I don't even want to plan for the worst. I want to plan for a great future. All right. I'm going to put my money in the stock market because I believe we're going to have a great future. And that's the way it's been for the last 200 years. I think it's going to continue, at least through my lifetime, and probably yours too. I think we're going to have a good future. Okay. All right. So let's look at one more, and then we'll call it quits. Let's come in here and we'll let you do this. And then next week, we're going to go look at some other ETFs, and we're going to show you some other really cool stuff. All right. So stick with me. Come back next Monday. But before that, let's look at a couple more of these. Let's look at, just for fun, we'll just go pull up each one of them in this little program that we got here in Portfolio Matrix, and we'll look at each one of these. So we've got the VIG. Let's look at the VIG. So the VIG had a gain of 11% and a yield of 1.7. So that's 13.5%. That's killer. Anything above 10% is killer. All right. So you could say you have yellow, you have green, and you have red. Let's do it the other way. We have red, we have yellow, and we have green. And let's have super brightest green you can imagine. All right. So anything that's less than 3 to 5% is going to be down in the red. Anything that's between 3 and 10%, anything above you can get at Cash Valley Bank. Let's say 5%. All right. So anything below 5% is red. Anything above 5% up to 10%, that's yellow. That's actually should be light green. That's nice. Anything above 5% to 10%, that's good money. That's nice light green. But anything above 10% is going to be super bright green. That's like, aha, that's like fantastic. Anything above 10% is great, great, great. So think of that as your wheel. All right. Anything above 10% is really good. Anything less than you can get at Cash Valley Bank is bad, red. Okay. Because why would you put anything at risk for what you can go down to Cash Valley Bank and get for no risk? Makes sense, right? I can put it in Cash Valley Bank and a bank CD and I can get 3%, no risk. I'm guaranteed my 3%. So why would you come and put your money into the market to get 3% and have risk that you could get less? So that's why we're going to say anything below 3%, 4% is red. Don't do it. Anything above that is good. And 10% is like our goal, and anything above 10% is like rocking. So this is a rocking VIG, is rocking because it's 13%. Okay. So now we're going to come in and we're going to go to VYM was the other one in our list, right? VYM, Vanguard. And that one is rocking too. It's 13%. Now, what are these other numbers in here? Standard deviation, max range, yield deviation, max range. It's when you have a price. Let me show you what the deviations are. Let's come over to our trading platform. And I'm going to come in, I'm going to turn off delete all the drawings. Oops, that was an accident. I didn't mean to close the program. I meant to delete I want to remove all the drawings, delete all the drawings. Okay, I'm going to turn off this. I'm going to turn off this. So all we've got is price, all right? So as the market moves through price and time, there's a little tool in here we can call, it's called the Bollinger Bands. And see how the Bollinger Bands move across it? This is called the standard deviation. Now, if you look in the Bollinger Bands on here, it's set to one standard deviation, or a deviation of 200, which is two standard deviations, all right? So two standard deviations, one standard deviation above, one standard deviation below. And so the market is telling you when it's outside of one standard deviation or below one standard deviation. But the point is that the market isn't flat. Stocks don't do this. They don't just go straight up or straight down, okay, or straight across. That's not how they work, right? They go in waves, up and down, up and down, up and down, up and down, like this, up, down, up, down, up, down, up, down, up, down. That's what markets do. Well, in the process of doing that up and down, you had a top range and you had a lower range, okay? So the standard deviation is how much does that fluctuate within that channel of just the market going through its price channel. What's the fluctuation, ups and downs? Remember, we talked about that last night where I was like, I look at my phone and then, oh no, I just lost this much. And then the next day, oh, I'm up this much. Oh, I'm down this much. Oh, I'm up this much. And now I'm down this much each day. And it causes stress on people who watch their markets every single day. That's why I was saying the difference between real estate and the stock market is you have less stress in the real estate because you can't sit there and watch the price of your real estate value, your prices go up and down while you're sitting there at breakfast. You don't have that capability. It's not that they're not, they certainly are. They're going up and down in value like that as the market moves, but you can see it in the stock market more clearly because you have a little device in your hand that shows you the ups and downs or the standard deviation occurring as it occurs, like watching, what do they say? Watching salami be made, right? So you don't want to watch that stuff. You just go ahead and eat it, tastes good, but don't watch them make it because that's going to scare you. So that's what this is. It's the standard deviation. How much does this thing fluctuate during its process of making this return? So if we come over here and we look back at this, it's going to tell you what the standard deviation is. It fluctuates 4%. And maximum, it's fluctuated as much as 15. That's what this was right here, 15%. So if you're watching it on a daily basis, you're going to see it fluctuate on a regular basis, the standard deviation, about 4%. Up and down 4%, one up, 4% up or 4% down. And then max range, it can fluctuate as much as 15%. Now you're only making a gain of 10, but it's fluctuated in the last year as much as 15. So, oh man, that's scary. All right. This is the fear and greed model that we work with when we're trading the stock market. You have to control your fear. You have to control your greed. And so by knowing what these standard deviations are, if you're looking at your little phone and you're saying, oh, well, it's within the standard deviation, there's nothing to freak out about. Yeah, I'm down, I'm down $400 or whatever it is, $40 or $400. It's still just a percent gain of however much you've got in there. And the standard deviation is how much you're going to see the fluctuation on average. Okay. So that's what these numbers are. And it's very helpful to know those numbers so that you know how volatile the market is that you're trading. So VYM, it's got a standard deviation of 4 and the yield deviation of 4, not very volatile. Okay, it's pretty stable company. All right, it's pretty stable. Some of these volatilities can get really wild. Now, max range of 15 is that's pretty big. So, anything you start getting up into 25s, that's catastrophic. All right, that if it starts getting up into a standard deviation of 25, you are in trouble. Okay, you don't want to be doing that. That's scary. Scary. That means it can fluctuate 25% changes on your standard deviation. Okay. Not that you can't get there. There's certainly some that'll get there, and you might want to get in them anyway, because it's the fluctuation of the market that makes returns big, right? So if you want big returns, you're going to have a lot of standard deviation adjustments. So it's all the risk reward ratios. The more risk you're willing to take, the more chances you have at a larger income. Okay, so they go hand in hand. So that one was the VIG. Oh no, that was VYM. Now we're going to go, we looked at SCHD, SCHG, JEPI. Let's look at DGRO. DGRO, okay? All right, DGRO, well, this is pretty good. It's got a gain of 10, standard deviation of 4, pretty standard across the board, max range of 14, and then a yield of 2.17. So it's a little bit more gain, yield's a little bit less. Can't get, I mean, you can get better than that at Cash Valley Bank, but this is where you're going to worry a little bit more about gain. But you're going to come down here and it pays out quarterly. It doesn't pay out monthly. And then it's not going to ring the bell for you. And so you're going to get a 12% return on DGRO. It's nice, good little stock, good little place to put your money. Great, wonderful, 12% return. Anything above 10, you're screaming happy, right? You're screaming happy. Okay, so that's DGRO. We did JEPQ. Let's do the last one. Or we got two more. VYMI. VYMI. And VYMI. Come on, baby, load that thing up. Vanguard International High Dividend Yield Index Fund. VM, why isn't it loading? Come on, no dividends declared. I don't know why that one's not pulling up. Let's look at FDVV. Okay, FDVV is coming up. Fidelity, they got a gain of 11%. Just their gain alone is above 10. That's good, right? And then we got yield is at 3.38. That's good. Look at that, a gain of 14.75. That's our biggest one, isn't it? FDVV. That's our biggest one. It's got 14.75. Did we have a 15? I thought we had a 15. I can't remember. I didn't write them down. That's good. 14.75. Let's go look and see what's in this one. FDVV. We're going to go back over to this little program here. And we're going to come in and we're going to look at, now I'm going to tell you, let's pull it up. FDVV. Okay. Why does it keep pulling that thing up? Just pull up the chart, buddy. All right. Now we're going to come down here and we're going to say show all. What is this thing invested in? NVIDIA, Microsoft, Apple, Broadcom, JP Morgan Chase, ABN, Amaro, Barrick. I don't know why it doesn't have a link to it. Visa, ExxonMobil, Bank of America, Coca-Cola, Philip Morris, Citigroup, Wells Fargo, Altera, Procter & Gamble, Pepsi, Hershey, Nextera, Chevron, EAS, American Electric, CME, Savenska, Heskavenska, Southern Company, Duke Energy, Alphabet, U.S. Bank Corp, and Dominion, and Annaly Capital. So that's what they've got theirs invested in. Of course, you can see they're very heavily invested up here at the top in a lot of the big tech firms. So I got NVIDIA, Microsoft, Apple, Broadcom, and then they go into the banks, JP Morgan, Visa, and then they go into energy, Bank of America, Exxon. So these are their big ones, Coca-Cola, Philip Morris. So that, they've just got some of the big S&Ps, some of the big large cap funds in there. This is their technology sector, consumer non-durables. They got some utilities in here to keep it stable. Got a little bit more finance in there, energy, minerals. Okay, so they got a nice little spread in there. So that's FDVV. All right, now I want to do one more thing, and then we can go. So we're going to go into the little compare window in here, and I'm just going to put them all in here. Now, you got to remember, this is growth only, and so the ones that do dividends, where they're taking the money out, and the growth is small, isn't going to show up as good as the growth ones. But we're just going to put them all in here and see what they all do. VIG, VYM, SCHD, SCHG, JEPI, DGRO, JEPQ, VYMI, FDVV. And one of those didn't come up on the other list. So, and then we're going to put the SPY in there. And why not? Let's put the QQQ. I don't know if it'll do that many, but we'll see if it'll do all those. Okay, there's your list. Now remember, the ones that are going to do high dividends are going to be down here in the low because they're taking the money out. So that's not shown. And that's one of the problems with most brokerage and charting software, even our trading platform. Even our trading platform does not calculate dividends into the, all it's doing is growth. It's just growth. That's all that it pays attention to. Trading platforms, all it does is growth. Come over here, FinViz, all they're doing is growth. They don't do what Founders Edition here, Portfolio Matrix does with this breaking it out, growth and yield. They don't tell you how much is gain, growth, how much is yield. They don't, nobody breaks that out. So if we're looking at this, they're just combining them. So it's just growth. That's all it is. And they're throwing the dividend back in as growth. So you can see, what's the blue one? The very highest one is the VIG. Now the problem is that VIG and QQQ look exactly the same. So I'm going to, it's the biggest one is QQQ. So that highest one way up there is QQQ. You know what the Qs are? Let's go over the Qs. In fact, we want to go back out and look at the stock detail. Well, we'll go look at the Qs. I'll show you what the Qs are. The Qs are the NASDAQ, and it's primarily your big tech stocks. All the Apple, Amazon, Netflix, Google, all those big tech stocks, NVIDIA, they're the ones that are making all the, we're in what, everybody's considering it to be an AI bubble, right? Those big tech stocks are the ones that's pulling the whole Qs up. So all the other Qs, if you take those out, it's a little lackluster. But because of the tech bubble, the Qs are really heavy into all the tech stuff. So it's pulling those up. All right. Now the Qs, the dividend, let's go look at the dividends on the Qs. It's not going to say it's, well, let's look. I'm not sure. Yeah, it's terrible. But it's the growth. Look at that. So it's 28.44% growth because of the AI bubble that we're in, and that's what's pulling that up there. And then you get your little 0.53% on the dividends on the yield. So for a total of 28.97% in the last year. All right, calculating out 28.97. We come over here, back over here, you can see that it's the top dog, QQQ. So, and then the next one is red. That's the SCHG. SCHG, we talked about that one. That's at 29%. Now remember, anything above 10 is bright green. We love it. Love, love, love anything above 10. Now, the difference is that these are growth. There's no yield in here. I mean, they've got yield, but this is not counting that into consideration. So then the next one is that little kind of VYMI at 20%. And then we got the SPY, there's SPY right there at 20.35%. And then that light blue one, that's down there. I think that's the VIG. This is VIG. And then we got the FDVV is right, the yellow one. And then the orange one is VYM. And then there's another one on there. It looks like DGRO. And then under that is the pink one, JEPQ. That's JEPQ right there. And then there is a little purple one. That's JEP-E way down there. That one's a dividend one though, remember? So, and then we got this little green one here, SCHD, which is another dividend. So the two dividend ones are lowest. And that's because they're only showing you the growth. They're not showing you the dividends. Okay. All right. That's it. That's the name of the game. And that's how you calculate these things. And next week, we're going to go in and we're going to switch over and we're going to start doing, right? If you remember, last night, we talked about the different levels. And so we talked about growth. That's just your individual stock. We talked about extrinsic value. That's growth. That's the building and the rent. So that's like your stock and your dividends. And then next week, we're going to, the grand finale is going to be entrepreneurship. We're going to do exponential compounded growth. All right. We're going to learn all about how to be an entrepreneur and start a business in the stock market. All right. So this one is just buy low, sell high. Just like anything, you're going to go make a widget, you're going to go make a number 2 pencil, and you're going to sell it. You buy it for however much it costs you. And then this one here, you're going to intrinsic value. This is going to be a rental property. You got your house and your rent. And then this one is going to be starting a business. And I want you to run your I want you to trade in the stock market like a business. And that's what we're going to do. And that's what we're going to talk about next week. All right. Next week's all about how to start your business in the stock market without having to get telephones and employees. That's a good thing. If it wasn't for customers, telephones, and employees, being in business would be fun. All right, so we're going to eliminate all the things that we don't like about business, and we're going to do it in the stock market. All right, there you go. All right, guys. Glad you had a fun class. Some of you did anyway. If you liked the class, hit the little thumbs up. That always lets me know that you liked it. Go down there and hit that little thumbs up. And if you haven't subscribed to the channel, go ahead and do that now so that every time we go live and we have another lab, you can come and participate. YouTube will send you a notice. All right. So this is Friday. So have a good weekend. Today is a holiday. Go out, get lots of candy and share candy and do all the things that you do on Halloween. And we will see you bright and early Monday, because Monday at the university, this next week is a 3-day class. It's Monday, Wednesday, and Friday. And remember, on Friday we got my son coming as a guest speaker. He's flying in all the way from Nashville just to teach this class on Friday. All right, so we'll see you guys then. We'll see you Monday morning, or Monday evening at 6:00 p.m. at the university. Take care. All right, we got to end. We got to play with some of this stuff. Hold on. Don't run off. We got to do this one first. We got to do what one here? We got to do this one here. Let's do this one.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first two issues for just $1. Yep, only a buck. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out. Risk-free. Satisfaction guaranteed. Or your money back. Visit pittnews.com. That's PITnews.com. Pitt News Magazine. News your way.
All right, guys. We'll let you go. Have a good weekend, good holiday, and we'll see you Monday evening at the university.
All right. That wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.